Hi everybody. Most people think small investors are weak. I think small investors can act in such a way that bigger players can't, which makes them strong. Think of a crowded street market. The big truck cannot enter the small lanes, but the scooter can go inside and buy the things early. Big players are like the truck, small players are like the scooters. In this video, we will give 3 practical steps that any small investors can act upon to generate even higher returns than the big players. Let's look into it. Step number 1 is to work on small and micro cap companies. Efficient market hypothesis states that the price of a stock reflects all of the information available because there are so many players and analysts tracking that stock. Most financial institutions and research analysts focuses on high market cap companies because that is the only area that they can put their big money into and generate returns. This leaves the small and micro cap companies an unexplored area. This area of small and micro cap companies is an opportunity for small investors where they can generate massive returns and even beat larger players. There are 3 reasons behind it. Firstly, as there are fewer analysts and fewer institutions tracking this area, so there is less storytelling in the media, which frequently creates a gap between price and value. Due to this, small investors have an advantage of having more number of undervalued situations in which they can put their money into. Secondly, small businesses with 50 to 500 crores of revenue can compound their growth faster. Even if the business becomes mid-sized, the stock of a small business can deliver outsized returns for the small investors. And lastly, small investors can build meaningful position in these companies without moving the price much. So, while big players can't put their money into small-sized companies, small investors have huge advantage because they can put their money into it. It is just like fishing in a pond where whales can't enter. Step number 2 is to value the business. Valuation of a business depends upon the present value of all of the future cash flows of the business. The method requires you to study the business very carefully and use financial models to predict the future earnings and cash flows. But is it easy to do that? In reality, most analysts have hard time predicting even the business earnings of even the next 1 quarter. But the good thing is we don't need to do that. Instead, we should use the concept of opportunity cost. It works something like this. Can you answer the question how much the planet Jupiter weighs? No, right? But can you answer the question, does the planet Jupiter weighs more than the planet Pluto? Quite easily. Similarly, it is very difficult to find the exact value of a business, but it is relatively easier to say if one is more attractive than the other. So the alternative we can take is either 8% or the long-term investment rate of government bonds. This can act as a filter in your investment process. If the current earnings yield of a business is less than 8%, you can move on to another business. But if the current earnings yield of a business is greater than 8%, that business will pass to the next step. And step number 3 is to create a portfolio of stocks using the businesses that has passed the step number 2. Now, it may happen that some 15 to 20 businesses has passed that test, but the question is how would you give weightage to them? There are 2 variables that you can use. First is how good the quality of a business is, and second, how cheap the business is available. Warren Buffett says the quality of a business is very good if it is able to generate high return on capital and the management is treating the minority shareholders fairly. Cheapness of a business is decided by looking at the things like price to earnings ratio and price to book value ratio. So you have to find the right balance between the quality and the cheapness of businesses and accordingly give them weights. So these are the 3 steps, and if you follow these steps, you have the potential to beat the larger players. Further, as a small investor, you have one more added advantage. With the rise in technology, the clients of professional money managers can monitor their portfolio very easily, even on a daily basis. The short-sightedness of the clients forces the money managers to look at the investments from the short-term perspective. That makes the payoff for long-term view very high. So, the small investors have the added advantage to have long-term horizon. This means you have to sustain during the downturns. But our genetics forces us to make emotional decisions rather than rational decisions. So here is the tip that you can use to combat that. Don't look at your portfolio very frequently. Look at max once per month. So, summarizing the above points, if you are a small investor and want to beat the large investor, work with small and micro cap companies, use the opportunity cost concept to filter out the businesses, use cheapness and quality as measures to create the portfolio, and finally have long-term perspective. And let me end this video with one of the quotes of Charlie Munger. If you want to succeed in investments, start early, try hard and keep doing it. And that was it for today's video, and I hope this video was valuable to you. If this video provided some value, please like this video and subscribe to this channel. Thank you so much for watching. I will see you in the next video.